Test, 1, 2, 3. Wait, you're saying that most people who do that will trigger an audit?
It's gonna set you up for an audit.
Jeez, that's gonna be like a lot of people. So just 2 days ago, this happened.
Look what happened. Is this crazy?
Now, is it weird that I'm a bit nervous to even say his name on here, wondering if this video might get shadow banned? Right now, 47% of the country is feeling pretty upset. But if you're an investor, there might be a silver lining in all of this. A lot of people are asking, what's going to happen to my taxes now? In the least, entrepreneurs and investors no longer have to stress over policies like this, which could open the door for the IRS to tax unrealized capital gains. This isn't just a slippery slope for new tax revenue, it also shows a lack of understanding of how business and investment valuations really work, whether it's for the ultra-rich or not. No matter your background or beliefs, there's always a debate about who should pay more or less in taxes. But the real question that isn't ever being asked or debated is, how will the government be a good steward over tax dollars and reduce spending?
Elon Musk and former GOP presidential candidate Vivek Ramaswamy were announced as leaders of a new Department of Government Efficiency.
Now, let's be real, the tax code is nebulous and confusing at best. You hear things like depreciation schedule, cost segregation, and write-offs, but what do those really mean? And can anyone use them, or do you actually need a real strategy? Today, I'm sitting down with a good buddy, tax strategist, and enrolled agent, Kevin Smoot, to break down some of the biggest questions around tax strategies now that the 47th president is in office. But first, I'm going to show Kevin some recent projects from our community, from beginner to pro level, and see what tax strategy nuggets he can drop for each stage. This way, you can see the difference between just knowing the tax code and actually using it. And then after that, we'll answer all your burning questions on how to lower your income tax and what we think is coming next now that we've gone from blue to red. Now, as you may know, I'm still on my journey to 175,000 subscribers by the end of the year 2024. I've got about a month and a half left, so if you end up liking this video or you've been here before, give me a quick virtual high five and hit that subscribe button. Welcome back to the channel, Kev. Great to have you here again. All right, Kev, so this is Hannah and Willie. And Hannah is an entrepreneur. She's actually a fitness content creator. And then Willie works in medical sales. This is their home, and they invested about only $30,000 into this. This is in Arizona, and they did an actually stunning job here. They didn't do anything major. It's all furniture or furnishing and painting and artwork that $30,000 went into. But the really nice thing is that they were able to basically turn this place around. They did buy it that was recently renovated, but it just didn't have this character that you see in here. And they actually just launched this at the time of this filming. They launched this about, today's the 10th, so about 4 days ago. In the first 24 hours, they got 6 inquiries and 4 bookings for over $5,000 in the first day. Yeah. So they're set for success on this one. It's their first one. They're stoked. They're already working on deal number 2 right now. What can folks do that are first getting their feet wet? What do you see here? What are your thoughts?
I see high-end appliances, high-end finishes, which is great if you want to take the cost segregation approach. Doesn't seem like there's a lot of land here, which is, honestly, it's a pro because more costs can get allocated to the actual structure of the home than to the land. So if you're looking at a cost segregation approach to this, I think that this will come out pretty favorably because there's a little bit of land, there's a pool, there's high-end finishings, and then in addition to that, you've got the brand new furnishings too.
Can you expand a little bit more on why the least amount of land is important, and also why did you go towards a pool and deck? Why were those 2 things highlighted?
Yeah, so when you actually buy a home or a property, there's an allocation between land and the actual structure or building of the home. Land is not depreciable. So let's say you buy a $500,000 property, and let's say it's on 100 acres, and a lot gets allocated. Let's say 80% gets allocated to that land. Only 200,000 of that is going to be deductible, which is where you're going to get your deductions from. The rest, there's no depreciation whatsoever. There's no deduction, no depreciation at all. So when you have a pool and a deck that have the ability for you to be able to take bonus depreciation on instead of stretching it out over 39 years, then you get to take a larger chunk of the cost and depreciate that in the first year.
And then, so let's move on to level number 2. Now, this is Nagendra and Cintura, wonderful couple from California. Both are working professionals, and they wanted to build a real estate portfolio, but they weren't thrilled about the modest returns from long-term rentals, which we all know about. And they purchased this property here, and they completely renovated the interior and exterior of both homes. So there's about 5 acres right next to Yosemite, and there's 2 full-size houses. So it's not like an ADU and a main house. It's 2 full-size houses. They spent $200,000 total, furnishings and everything. But I think a lot of we're gonna see some overlap from level 1 to level 2. But what do you think, Kev, after seeing something like this?
So I think what a lot of people get caught up in is like cost seg. And cost segregation is done on the purchase. It's not done on the renovation. Technically, if they bought this home, yes, you could still need a cost segregation study for the actual purchase of it. But you want to be able to have those expenses from the renovations separated out. And that's where bookkeeping and organization comes in, so that we can basically analyze what the proper lifespan is going to be on the renovations as they happen. And then we can combine that with the cost segregation study and be able to effectively take the bonus depreciation more strategically.
So this one's a really cool one. This is the one that just launched this past summer. His name is Nithin. Awesome guy. We just launched, like I said, his first land hack project. He's never done real estate before. And he renovated and updated 3 cabins on 7.5 acres. Just this past summer. These were really beat up at one point in time when he first took them over. It was so bad, actually, that they had pest issues, mold, water was leaking through, but basically everything. Yeah, it was just horrible. Nithin took it over. We put a whole strategy together, and he launched these 3 here, and they're just absolutely killing it now. You can just see the difference. Stay there. It's actually been over the state of no payways, but a security didn't close to you, man. It's not that far away. It's actually a really romantic getaway for folks. But look at that, top 1%. I'm so proud of the guy. He did such a good job. Dude, that's what we aim for. Inside the program, I teach and I tell everybody we're aiming for the top 1%, and then he nailed it. But he wants to turn this into more of a commercial property where he can ultimately sell it with a cap rate and having, NOI and all that good stuff. That's a commercial deal. So where we're at here now, so he has plenty of space to expand on this, and based off of making $25,000 off those 3, I'm sure that he's going to be looking for another way of stacking another 3 or 4 onto this property. What's your insight on this one?
So of course, everybody's situation is going to be a little different. He's in New York, properties in Ohio. So I'd want to talk about, can he materially participate? Like, can he qualify for material participation? If you can qualify for material participation, this will allow you to write off the losses against your W-2 earnings. So for him, being in New York City and then the property being in Ohio, it's not like he's going to be commuting every week to, clean the property himself.
What activities can he do? So let's say that he's managed remotely. He's managing the subcontractors, he's doing the guest communications, the bookkeeping, all that stuff. Does that all count?
Yeah, all of that counts.
Okay, so anything that has to manage the property and the short-term rentals. Gotcha. Okay.
Anything related to that is going to be able to help out.
Awesome. All right. So that's a really big deal. And then you said that that's against this W-2. Now, Nithin's married. Does that also have an impact on his wife's income?
That would, yes. And her occupation would also matter there. Now, if she was solely focused on managing the rentals, that's fantastic. Because it'd be easier to qualify her for either material participation or as a real estate professional.
All right, so level 4 is our good friend Doug in West Virginia with his 10-acre landscape hotel. He invested in 10 acres in West Virginia and is developing what we call landscape hotel with domes, cabins, and basically future RV sites. Construction began just a couple months, or I shouldn't say couple, but several months ago, just before summer, and he's making great progress. And I know that you're already working really, really heavily and in depth with Doug, but what would you suggest for others tackling a similar project such as this that's going basically full on all commercial, not residential?
So the organize, analyze, strategize is going to be key here. And the biggest part is organization. Because as you're building, you are pulling money from here, from there. You are building different cabins. You are making different orders, dealing with different vendors. So the key here is going to be organization. And that's going to save you not only a ton of time, but it's going to save you a ton of money, because it's going to allow us to be able to strategize very strategically on the different projects that you have going on. And we have quite a few clients that are building different cabins and different sites at the same time.
Okay, cool. Can you touch on the PM now for this one?
Typically what happens is that there's like a stage one on strategy. The first stage of strategy is that you want to get the income as low as possible. Ultimately, you want to create a huge loss that's going to offset your W-2 income so you can get a big refund, and that helps you give a return on your initial investment. Stage two is going to be, all right, now that we have used a lot of depreciation up front, how do we create different ways to be able to still bring that income pretty low when there's your biggest expense, which is depreciation, is kind of faded away because you took advantage of it the first year. So stage two is where we would start to look at, okay, should we spin off a management company? Where a management company is a little bit different, because under a rental property, that's considered more passive income or non-passive that's not subject to self-employment tax. If you spin that income into a management company, then that income becomes subject to the self-employment tax, which is 15.3%.
But, you know, what were the tax implications around like new tools, trucks, trailers, anything like that that's dedicated towards the project?
Yeah, sure. And there's different stages to this. So like tools, like, you know, let's say you go to Home Depot, you pick up some tools. Those you can take 100% first year. Then you've got like your next level up, which is like a trailer. So a trailer, you know, you're going to hitch on the back and you're going to be hauling lumber or tools or supplies or whatever you want. That's going to get depreciated. Typically, we take bonus depreciation on that and expense it as much as we can in the first year.
What about like a new like Porsche?
So I get this question a lot. They're like, all right, I got my rental. You know, TikTok told me I need to buy a G-Wagon. Like, can I write it off? And my typical answer is no.
Oh, yeah.
There's ways, but to do it against a rental is going to set you up for an audit.
Okay. Okay. All right. So level 5. This is something that's really interesting. This is going to be a little bit different than anything else that we've looked at. And this is actually not one of our members. These are folks based out of North Carolina on 16 acres. And they started with just actually one tree house. And then they quickly grew up to, I believe, to 5 unique homes. So I believe there are 3 tree houses and 2 hobbit homes or earth homes. And then now they've expanded to, I think, 20 total homes in total. And this is the crazy part, is that their NOI, I believe I did a video on it, where we calculated their NOI, and it was approximately $1.7 million to $2 million. But when you're looking at something like this, for our folks who are either starting off and building their very first dome, their very first cabin on something like this, all the way to the point where they're building 20 doors and it's netting $20 or $2 million a year. You know, what do you see here for the tax implications?
So tax-wise, I would say early on, they're probably still working in a W-2 to fund the projects. So I would be as aggressive as possible with like the depreciation, just to make sure that they're maintaining that cash flow while not paying any tax on it. As they begin to transition, where you're getting to a point where you're like, all right, then my net income is bigger than my W-2, so I'm going to leave my W-2 job. Then the strategy is going to change a little bit, because you don't necessarily need to create a lot of losses in order to offset your W-2 income, because there is no W-2 income. What very few people realize is that there's a difference between Section 179 and bonus depreciation. Most people will just put those together and they'll just say, yeah, bonus 179. But actually, in the eyes of the IRS, they're completely separate. So Section 179 cannot create a loss. Bonus depreciation can create a loss. So in a situation like that, where they leave their jobs, they don't necessarily need those bosses, I would harness and strategize around simply getting the 179 down to 0 out the income, and then being able to roll forward more depreciation for the future.
I see. So do the 179 now, but you can't do if you do the 179, can you do the bonus depreciation later?
No.
No. Okay. Bonus
Appreciation later, but we're basically dealing with what's in front of us for the current year. We're saying, all right, we're going to zero out this income. And then for years after, we're going to be able to save that depreciation for future years.
Gotcha. So you can create a loss in the future years, or try to create a loss in the future years.
Or you're just simply rolling it forward because you don't have any use for it currently.
Got it. That's what we're saying.
And here's a different level. You can take bonus depreciation on different asset classes. And so there's a way where you can actually take bonus depreciation on one of your longer asset classes and then take either straight line, some of the years digits, double decline balance. There's all these different depreciation methods you can take on the other asset class so that you can combine it and be able to strategize around both. It can get complex, but often it's the part that's not talked about, that's overlooked.
Yeah, I mean, I would say I'm about chest deep in this stuff, and I haven't even heard of all those different strategies. Usually, I just push it all on you. Yeah, just push it onto you. So, but basically what you're saying is, it's not just like, oh, just go depreciate or go get bonus depreciation or get the cost seg. You're saying there's a lot more insight and strategy behind it based off of an individual's income, tax strategy, all of it, depending on how you want to use that. So it's obviously in a legal way, right? And it's something that I tend to say, and you and I talk about this all the time, is that the IRS actually wants us and encourages us to avoid paying taxes, but they will fine you, put you in jail if you evade taxes. Okay, good deal. Well, that wraps up the 5 levels. That's perfect, man. Thank you. Now, if you like those projects and you're looking to diversify your portfolio or even start one, you need to join my completely free community. You'll get access to my free training videos, check out the projects we've worked on, download my spreadsheets and guides, and the best part, connect with me and other like-minded people in our public group. We just launched, and I'd be pumped to see you in there and say hi. The link's in the description down below. All right, number 1, we talked about this already. What exactly is a 1031 exchange and how does it work?
Sure. So a 1031 exchange is a way for you to defer the capital gains on any kind of sale of a property that you have. The caveat is that you have to find a property that is either at or greater in value than the property that you're selling. That's the best way for you to approach it with being able to avoid taxes completely.
Are there tax benefits if I buy a property to live in?
Yes. So there are tax benefits. You'll be able to write off the mortgage interest and the real estate taxes. That's if you're buying a property just to live in it as your primary residence. If you're buying it as a rental, like if you're buying it and then renting out a portion of it, like house hacking, then you'll be able to write off insurance, utilities, property taxes, and the mortgage interest.
Next one is from one of our members, Tony. What deductions are available, and can you recommend any good books?
Tony, so if you are a client of mine, I would give you a complete template of all of the most common deductions for rental property. I don't have any books off the top of my head because we really just created a Cliff Notes version of all the books that you will find information on.
So if you guys, there's a link down below. You set up a call with Kevin, get in there, and then you guys will be able to get that template. Okay. All right. I got more than one book for you, Tony. All right. Here are the 2 books. I'm missing one because I've always lent them out and they never came back. These have been with me for over 20 some years, 21, 22, 23 years. These were the 2 that got me started. Well, actually, no. Rich Dad, Poor Dad. I probably have owned like 15 copies. I've always ended up giving them away, but these are the 2 that stuck with me. These helped me a lot. It's Crash for Quadrant by Rich Dad, Poor Dad, and then Real Estate Loopholes. I actually bought this from the library. You can see it right here. The Tipping Point, Malcolm Gladwell, and then The Black Swan. Really, really cool books. Applies to business, real estate, and just overall general life. Love those 2 books. Next one, MJ and Johnny asks, what accounting apps or software make expense tracking easy and shareable with accountants?
I love that they are thinking about your accountant here. Stessa is going to be more user-friendly. It's very simple. It's very cut to the chase. QuickBooks is going to be better for accountants because we're able to get in there and dive into like a general ledger. It may be too much for you as a user, but for us as accountants, we love it.
Perfect. Okay. Next one is Willie. What type of structures and improvements help maximize returns with cost segregations?
Yeah, so I know we touched on this earlier, but like pools, landscaping, decks, ADUs if you're doing additions, complete renovations. Those are all going to be very high on the cost segregation allocation list.
Next one's from Seneca. What's the best business structure for tax purposes? Do they flow through to the business members?
All right, so this is going to be it depends, because it's all going to depend on what goals you have and how you really want to structure the business. Ideally, you want a flow through entity, but you also want to look at, all right, is it going to be subject to self-employment tax? And it's a broad question, because what kind of business is it? Is this a rental? Or are you opening up like a retail shop? That is something that I would definitely recommend that you talk to an accountant first and then an attorney second to figure out what's going to be the best fit for you.
This is coming from Nathan. At what income level does it make sense to do cost segregation? And what are the downsides of using full depreciation upfront? So we just talked about this a little bit.
We did. Like you said before, if you're making $50,000, but you got $200,000 of losses, you don't want to use the entire 200 grand. So we want to be more strategic about our approach there.
Gotcha. Love it. Our last two here. When can you buy equipment such as cars, computers, phone plans under your business?
Anytime. If you need it for your business, buy it. I really can't give you a better answer than that. Like, you can start buying things for your business before you even start your business. And you can still pull those in to be able to deduct them under your business. Because there's going to be startup fees, there's going to be organizational fees, and the IRS allocates, right now it's $5,000 for each category that you can actually still deduct even though you hadn't started the business yet.
Wow. Okay, cool. I didn't know that. And last one's coming from Lindsay here. Do you need to rent out your property by year end to qualify for short-term rental tax benefits, or is having it available enough?
It has to be ready for rent. The best way to prove that it's ready for rent is if somebody is renting, right? So it's an argument that you don't want to have.
Okay.
Right? Because let's say, all right, there was no rent, and we're like, but we can get $400,000 of expenses in this first year.
Mm-hmm.
To do that without zero rent is going to raise the eyes of the IRS to say, is this ready for rent? Was it ready for rent?
Mm-hmm.
We should check this out.
Mm-hmm.
That's an argument that we don't want to have. So to be 100% safe, somehow, some way, some form or fashion, a renter was in there before the end of the year.
Gotcha. So obviously tax code and strategy can be very nuanced than most of us realize, except for maybe folks like Kev. But if you're facing similar questions, it might be time to work with a tax strategist, not just a CPA. Working with Kevin has provided me with checklists, templates, and just good, solid consultations through the years that have saved me hundreds of thousands, I think even potentially in the millions now, in taxes just over the years. You can use the link below to schedule a time to chat with Kevin and grab your free template to review your deductions. And if you're interested in learning how to find properties like the one that we showcased today, come join my free community. You can explore our portfolio, download my guides, and watch my free webinars and training videos. You'll definitely catch me, Kevin, and the rest of my team in there every week. All the links down below. Now, obviously, taxes are a key player in building wealth. Now, while investing in exciting projects is fun, leveraging the tax code to boost your returns is a total game changer. Remember, there's a way to create financial freedom while enjoying life and making money ethically. Death and taxes are the only guarantees that we have in life, so we might as well make them work for us. Remember, the IRS encourages tax avoidance, but will not tolerate tax evasion. See you in the next episode.